I'm Farzad Saidi, and in organizing this panel, I think the overarching motivation was that we've been talking a lot about macroprudential policies in the aftermath of the great financial crisis, of course, but seeing how interconnected the financial system has become with fairly heterogeneous financial intermediaries interacting, most importantly, not only banks, but also loads of non-banks, a whole zoo of non-banks, some regulated, some not. It's pretty worthwhile revisiting this question. And on top of that, in the course of multiple concurrent crises that we're still, punching through in this very moment, we've also seen a lot of non-financial and fiscal stabilization policies and that inadvertently interact with these macroprudential policies that we've had in place. So we're going to revisit the question of how macro and macroprudential policies, by which we mean what is the current scope and the optimal scope of macroprudential policies. And I have three excellent panelists joining us today on stage. Florian needs no introduction. That's what people say when somebody's important. In his case, he is actually important, but also he just introduced himself to you, so you know who he is. Let me just allow a personal remark, as he's also a co-author of mine and a very good friend. Having spent numerous years at the ECB, he is an utmost expert in the fields of banking and monetary policy, but he's one of the very few researchers you can find who are equally capable of mastering theoretical modeling and confronting the models with the data in the real world. And for that, I appreciate him a lot. I think the academic world and the policy world do as well. Then we have Cornelia Holthausen. She's Director General Macroprudential Policy and Financial Stability at the ECB. As such, she is naturally extremely well versed in the analysis of macroprudential policies and how developments in the banking sector interfere with the real economy in what is now a fairly fragmented euro area. And last but not least, Marco Pagano, who is a professor of finance at the University of Naples, Federico. Besides his multifarious leadership roles, if I may just highlight one, because that's the role in which I met you, Marco, was a leadership role at the Einaudi Institute in Rome. He has made enormous academic contributions in a lot of areas of finance, including banking and financial regulation, but most relevantly for this panel, and that's the reason why I reached out to him, in labor and finance, which puts him in a stellar position to critically reflect upon this huge range of stabilization policies that were implemented during the last couple of years. So without further ado, let me start actually with some forward guidance on how this panel is organized. We're going to start with 3 lightning talks. May I emphasize the word lightning, which is just should reflect the duration of these talks. We were talking about 8 minutes before. Then we're going to start with a discussion among the panelists, and then finally open up to the floor, hopefully allowing for a sufficiently large number of questions. Okay? So without further ado, I'm giving the floor to Florian Heider.
Thanks, Farzad, for these extremely kind words. And it's, again, a pleasure to be here and standing in front of you. So I'm going to share some thoughts on macroprudential policies. We're just going to make 3 points, okay? And I'm going to come back at the end reiterating them. And you don't have to agree with me. It's just, just putting it out there for discussion. So point number 1. Banks are complicated animals, but in the end, it's always about the assets. It's always about the assets. There are no such things as these spontaneous runs that just hit on the economy or whatever. So that's 1. 2, I have a very skeptical view on supervision. I think, it's necessary, but we shouldn't count on them too much because they're always a bit too late, which is understandable. I mean, it's difficult to close a bank down, right? I mean, it's like, oh, no, we're doing fine. We're going to do better next year. And then finally, keep it simple when it comes to regulation. So Ricardo's in the room. This is a very nice paper. The point I want to make here with this graph is that there's always an asset deterioration that precedes eventual failure. I mean, it's always the train wreck that you see it coming almost in slow motion. So what you see here is quarters to failure. So last call is when the bank has failed. And just focus on the brown line. That's equity to assets. And you can see that 1.5 years before, the equity to assets starts to deteriorate. Right? So it's not coming out of the blue on average. And there's other things that are going on in this graph. But for example, if you look at something like the net interest margin, you don't see anything there. So equity is a good place to look for when you're looking for troubles for individual banks or the banking sector as a whole. A related paper using Italian work, it more or less has the same, to me, the same punchline is, again, you see it coming. You see it coming. So what you see here, again, is time, and then you see deposits at non-distressed banks, the control group, and a couple of or more than a couple distressed banks. And the red line is when the first troubles become public. It's fraud. And you see that there's something happening to the red line. So the red line are the distressed banks' deposits, but it's not so dramatic. So essentially what they show in the paper, these are corporate customers taking out the loans or not renewing the loans. Okay, so it's happening again on the asset side. And then the second blue line, a year later, that's when the supervisory report comes out, the SREP report comes out, and then everybody else starts to withdraw, so the depositors start to withdraw. So again, it's on the asset side, and it's slow, and you see it coming, and the regulators or the supervisors are late. Okay, we have regulation to deal with this, and in particular macroprudential regulation, and I've called it a zoo. This is from a survey paper by Christian Forbes in the annual review. Take your favorite pick. Right? And there's more because OT is other that they couldn't classify. So you have your favorite pick, and then on the left axis, it's like a histogram, right? It's how often they're used, or in this particular case, what's the stance. What you see is that, well, capital is used a lot, some loan restrictions, loan to value, liquidity, and foreign exchange, but everything else as well. And you have like 20 measures, and keeping track of these things and making sure that they all do the right thing, I don't know. I mean, it seems like a tall order. It's a very complicated optimization problem. So my point, the last 2 slides, is just keep it simple. So first of all, be clear what the problem is. And that often gets forgotten. And by the way, here I'm drawing on theory work, echoing a little bit the various points before there. There's also a home for theorists and central banks. So often it's a pecuniary externality. So usually some fire sale, right? You're selling assets for cash. Everybody does it at the same time. Price falls, and you have to sell actually more, et cetera, et cetera. And to prevent that, there's this macroprudential regulation that imposes taxes or quantity restrictions, right? You don't like margins, you do a cap on that. You don't like loan making, you give a cap on it. You don't like this, you tax it. You don't like that, et cetera, et cetera. The list is endless. But often that's not the problem. The problem is that there are certain markets that are just not functioning or not there at all. So I have a paper with Marie Hover and Bruno Billet, where we basically showed that the fire sales are not, you're just posing it out there as a sort of a devil's advocate argument that the fire sales need not be inefficient. So there is no argument for regulation, precisely because there is a market existing in the model that incidentally we don't have in reality, which is a market where you can hedge house prices. And then the question is not so much about taxing or restricting the quantities of certain instruments, but you have to ask yourself is why is there no hedging market on house prices? What is the real friction there? And that shifts the focus of the debate. It's not so much more about coming yet up with another regulation, but it's just thinking about, okay, which markets do we need? What do we need, for example, what hedging markets do we need for banks, and what happens if they don't work? So that's shifting the debate. And the last point I want to make is that, just keeping it simple, is I stick to the stuff that we know works, and we know how to do, and it's easy to observe. Stick to liquidity and leverage regulation. And yet another theory paper that I shamelessly promote here, but I think it's kind of interesting because it's actually not very often that you get coexistence of regulation in theory models, and we again have the same starting point. The assets are the problem. The bank assets are the problem. And you cannot take that as given. The assets are endogenous, right? How risky they are is a choice. I mean, that's what SVB, they made a choice. Everybody, Credit Suisse makes a choice. Everybody makes a choice. And so it's endogenous, and you can improve the incentives by holding something that's not risky, cash. Well, banks don't like cash because cash means you're not getting the nice returns on something risky. So they try to avoid it or really postpone it to the last possible moment, hence the fire sale problem or the coordination problem. It's like everybody thinks, yeah, well, no problem. When the economy starts turning south, we're gonna raise cash in the market. Well, guess what? Everybody does the same. And you have a problem, and that's why you have to regulate and require banks to hold liquidity, which note is a very different justification than what we see in Basel, where you just count how many outflows could there be, and how much could be coming in, and you take a ratio, and that's it. It's think about the assets, and what can we do to make the asset problems, the endogenous incentive problems or information problems about assets that are opaque, that can be dealt with, how to address that. And so where does capital regulation come in here? Well, not only does each bank free ride on each other when looking for liquidity, they also free ride on the entire system, because if we had fewer banks, then there would be more supply for money coming from elsewhere for those banks, because capital is scarce, right? I mean, it's either in the banks, where we have it as a problem, or it's in the non-banks. We're not going to talk much about non-banks today here, unfortunately. But so that's sort of the bottom line. And you could think of capital regulation as sort of the ultimate macro-proof tool, because it taxes banking and allows capital to wander elsewhere in the financial system. Okay, so in sum, equity is sort of a sufficient statistic for things go wrong. I would say, don't always regulate the hell out of things. Focus on incentives and pricing, and let the market do some of the heavy lifting as well, and keep it simple, because, the world is complicated enough. Thank you.
So thanks very much. It's a pleasure to be here and to answer the question, how macro are macroprudential policies, the name of the panel. And I would say, the bottom line, they're very macro. Their intention is to be macro. I mean, very often people say, okay, macroprudential measures, what's the difference? Both have capital requirements basically for banks, but it's really the objective that differs a lot. And I think there are a lot more commonalities of macroprudential policies also with other more macro type policies. So I suggest to look at 3 different types of policies: monetary policy, fiscal policy, and macroprudential policies. And all of these, I think they have to be seen in conjunction in some way. So all of these have their own objectives. Fiscal policy, in particular in times of crisis, the fiscal and the macroprudential policies are first lines of defense for their respective areas. One is more for economic stabilization, and the other one is more for the stabilization of the financial sector. And both of these really have a function in relation to monetary policy, because if they are done well, then they enable monetary policy makers to do their job really well. So if we have a prudent fiscal stance and then fiscal policy that can interact in terms of crisis, then monetary policy is much more able to also potentially increase rates in times when the economic situation is a bit more fragile. And at the same time, financial stability, if done well in the form, and so for prudential policies, if done well, they can really help to tame financial stability, and again, creating more space for monetary policy to act and to focus on their price stability goal. So, and this holds in particular in the euro area, where everything is more complex than in other countries, and where both fiscal and macroprudential policies are also done on a national basis. So here it's particularly important to really watch out how they interact and how they are conducted. So let me focus a bit on the macroprudential policy. So traditionally, we say there are basically two objectives. The one is strengthening the resilience and of the financial sector and to support the credit provision, in particular in periods of distress. And the other one is more the leaning against the wind argument. So to say we want to tame the upswing of the financial cycle to avoid that then there may be, in case of stress times, there may be a very severe downturn that also has effects on the real economy. And that, of course, is also a way of strengthening the resilience. So it's smooths the financial cycle. And we typically look at two types of macroprudential measures that we use to achieve these goals. One is the typical capital-based measure, so the CCYB and the systemic risk buffer. I think they have an immediate impact on strengthening the resilience of the system because they first of all strengthen the resilience of each individual bank, and then all of this, of course, adds up to the total level of capital that is in the system. Where the borrower-based measures, they can more be seen as an instrument to tame the upswing of the financial cycle, but only if they are binding. Yeah? So only if they are set at a sufficiently high level that actually has an impact on the provision of credit. And thereby they all interact. So we have, over the last few years, come to the conclusion that it's really the resilience argument that is more important, because we do see that there are some, it's not so easy actually to tame the financial cycle with macroprudential measures. It actually has a relatively limited impact. So we tend to see that we would focus more on the resilience part. And let me come to one point that Florian said is also, you mentioned the non-banks, right? And this is what I mean here, to encourage a system-wide perspective in financial regulation, because I think it's also really very important to look at the non-banking sector. But now in the euro area, that sector is still relatively small compared to the US, say, but it's really growing in importance, and I think it's already like around 40 or 50% of credit to the real economy that actually goes through non-banks. So we are starting to monitor this ever closer, and I think there's also a good point to be made to adopt macroprudential measures there, because non-banks are very much interconnected with banks. Often it's the banks that provide funding to them, so you have an issue of leverage. And the other big issue is that there is an issue of liquidity mismatch, which is much regulated in banks, but not in the non-bank sector. And I think because of this interconnectedness and because of their systemic relevance, there's also a very good point in regulating these. So in terms of the interaction, I think one very good case in point was, of course, the pandemic. I mean, that was a huge shock. Nobody understood it. So from all these three aspects, everyone threw measures at the system to ensure that the economy would continue to run, that there was sufficient funding in the system, and to keep the whole system going, basically. So on the fiscal policy side, you had loan guarantees and moratoria, you had the working schemes, you had lots of other support measures. On the macroprudential side, the point is there, we didn't have much macroprudential space built up in the euro area at that point in time, so there was not very much that could be released. So in effect, it was only around 20 billion of CET1 capital that was released at that point in time. So the bulk of relief took place via macroprudential measures. So the SSM, they did some measures related to the P2R and P2G, so on the level 2 requirements and guidance for capital levels of banks. And there actually they were able to release 120 billion of capital on paper. And then the monetary policy, of course, also threw money into the system to ensure that the system continues to function. So here, all of these policies had a bit a different objective, but also to some extent the same one. And I must say, none of this, I think, was coordinated at all. And of course, in the euro area, particularly so, because you cannot even talk to each other. I mean, some are national, some are international. And with retrospect, I think it was probably too much that was done at that point in time. So as I said, at the beginning of the pandemic, the macroprudential space that was built up in the euro area was very, very little. So there were only a few countries that had a countercyclical capital buffer. And then during the pandemic, as I said, most of the measures were done at the macroprudential level. But it's not the same, because there it was not that buffers were released. The buffers were still there, but the banks were granted permission to go below the buffers. And we know, and we have some econometric studies that show that banks don't do that. They don't like getting even close to the buffer requirement that they have, and definitely not below, because there's a stigma either towards the supervisor or towards the other market participants. So they really don't like it. So if you want it to be effective, it has to be really a lowering of the capital requirements, the total requirement that they face, because they still like to keep a buffer on top of that. And that's why we would argue that having a macroprudential buffer, having enough space there that they can really be lowered in times of crisis, that would probably be more effective in sustaining lending to the real economy and avoiding deleveraging. So, and I think this is, so among the macroprudential authorities in Europe, a bit a commonplace, or at least in the central banking world, I should say. So there's now much more proactive use of releasable capital buffers. Almost all countries in the euro area have built up now a CCYB, some systemic risk buffer. Timidly, no, like 1% maybe on average, more or less. And it takes time to build them up, because when you are now, first you have to lengthy process to decide on them, and then you always give one year implementation lag so banks can prepare for that. So it's a really slow measure, and some were then reluctant to do it when, the war in Ukraine broke out, so no one knew how this would affect banks, so a lot was postponed. But in the end, I think we're getting there, and it's more commonly used. And so we tend to think what would be good is to have what we call the positive neutral CCYB. I don't know whether that's a term that anyone outside central banks uses, but meaning that you should, in normal times, keep a positive level of a CCYB, that they can be released. And you don't need a particular reason to build it up. It should just be built up, and then it's simply there. So, and we think that would definitely enhance the banking system's ability to withstand shocks. And again, to the link to monetary policy, that would make monetary policy much easier to conduct. So if now, say, I mean, the supply shock in the COVID times was a very good case in point. No, monetary policy really needed to increase interest rates. And that was at a point in time when no one was sure how that would affect the banking sector. That was, of course, also hit by this and by the economic downturn that was a result of the shock. So we argue that with these releasable buffers, it's better for monetary policy. Yeah, that's it.
Okay, it's a pleasure for me to present after Florian and Cornelia and to build on what they said. Farzad asked me to deal with the interconnections or the interplay, if you wish, between monetary, macroprudential, and fiscal levers in stabilization policy. And in order to deal with this topic, the interconnections, we better understand what are the relative merits, if you wish, the pros and cons of, or the comparative advantages of these three policy levers. And as we all know, monetary policy has one key advantage, which is that it is fast. You can change or announce to change monetary policy, say the interest rates, the policy rates overnight. And the effects are also pervasive and immediate in the sense that, as Jeremy Stein once said, monetary policy gets in all the cracks. However, it is a blunt policy tool in the sense that we know, and we have learned to know, that unfortunately it is not susceptible of fine-tuning to specific jurisdictions, to specific markets, specific institutions. So it is a kind of unsatisfactory as a policy tool, especially at time of asymmetric shocks. Macroprudential policy is a bit like the opposite. It is, as Cornelia explained very well, mostly a preemptive type of policy tool in the sense that it should be set up in advance in order to moderate the buildup of imbalances and the possible effects once these imbalances actually realize. But and it has the advantage, partly as a result of this, and partly as a result of what Florian was saying, that it is, made up of so many different possible sub-tools, and partly because of also what Cornelia said, that it is often fragmented across different regulators. It is slow. So it's just the opposite, in a way, of monetary policy. But it's also the opposite on the good side, because it can be tailored. It can be fine-tuned to specific jurisdictions, specific markets, specific institutions. So there is there a complementarity, potentially, as Cornelia pointed out. Then fiscal policy. Fiscal policy is the typical endgame tool. Essentially, it is key to address solvency issues through bailouts or through loan guarantees. Like macroprudential policy, it can be tailored to specific institutions, to specific, even down to specific firms. And like macroprudential policy, it tends to be slow, but we have learned during the COVID crisis that it can actually be made rather quick. So what are the lessons, more specifically, from the two last big crises that we have been hit by, regarding the relative merits that I just described of these policy tools, and also the interactions of them? Well, as I said, the global financial crisis taught us the hard way that monetary policy is too blunt, and it is wise actually to pair it with macroprudential policy to preempt instability and to limit its effect. And in fact, as Cornelia pointed out, to actually unshackle to some extent monetary policy itself, enable monetary policy to be a bit more courageous, because it does not have to fear so much the negative effects in terms of instability that it can cause. Fiscal policy, we have learned during the great financial crisis, is the ultimate backstop. Of course, this is no surprise, but it's kind of striking that in the US, for instance, turmoil stopped only with the TARP announcement, essentially the bailout of banks, and the same in Europe. What have we learned from COVID-19? COVID-19 has, to some extent, restored our faith in monetary policy. If you look at graphs, for instance, of how much M2 has changed in COVID-19, even relative to the great financial crisis, it was an immense expansion of expansion in monetary policy, and was super fast. And it was key in restoring liquidity provision to firms. It prevented effectively many affected firms from running out of cash. But again, it was blunt, and that's where fiscal policy kicked in. It was able to deal with a shock that was, as I said, asymmetric, very heterogeneous, because effectively it was hitting firms that were more exposed to social distancing regulations much more than other firms. Fiscal policy was able to come to the rescue of these firms in a very effective way, because we saw the deployment of a whole array of tools, loan guarantees, short-term work programs, selective bailouts, that were like more surgically directed to the more affected firms. As Cornelia said, macroprudential policy largely took a backseat in this crisis, a relatively minor role for reasons that she explained very well. But partly also because the crisis was triggered by a real shock, not by a financial one. So in a way, probably this was, to be expected. Now, what was feared when COVID-19 started? Well, we all know that it was a sudden, violent, and shock of unknown persistence. It was hitting firms both on the supply and on the demand side, and as I already mentioned, it was very heterogeneous. And many expected lots of firms, of these affected firms, to run out of liquidity and go bankrupt, or alternatively, to overcome the crisis, but be so overloaded with debt as to face a huge debt overhang problem post-pandemic. Now, what actually happened was rather different. First, okay, we were lucky that vaccines came forward so quickly, so the shock was less persistent than initially feared. But a large role, as I already mentioned, was taken by monetary policy with this sudden, huge monetary response, but also by the fiscal policy reaction that compensated the bluntness of monetary policy expansion being tailored to specifically to most exposed firms. As a result of this rather well-coordinated policy mix, for once, banks and markets were not part of the problem, were part of the solution, and in sharp contrast with what had happened during the global financial crisis. Now, so in particular, let's focus on the most novel program in a way that we had not seen at work in previous episodes of, definitely not in the great financial crisis, the COVID loan guarantee program. Can we say it was a success? Well, to a large extent, we can. There was, of course, some wastefulness. In fact, it has been documented quite well by a number of early papers regarding the US experience. There is no such evidence, in fact, for Europe. It is true that banks appropriated in the Eurozone some of the benefits of public loan guarantees by reducing their pre-existing risk exposures, as I've shown in my own work with Altavilla and co-authors. But on the whole, borrowing enabled by loan guarantees did not lead to excess risk-taking, debt overhang, and zombie lending, as many, including myself, actually had feared at the beginning. Eurozone guarantees in particular were predominantly granted to small but relatively creditworthy firms. There is a nice paper, CPR policy paper by Cao and co-authors that builds on a questionnaire administered in a number of countries that finds no evidence of extensive moral hazard by banks in the respondent countries. And moreover, there is so far no evidence of cliff effects upon the termination of the loan guarantee programs. In particular, there is a very recent working paper at the Banca d'Italia by Emilia Bonaccorsi Di Patti and co-authors that shows that so far the fact that now these loan guarantees are expiring does not seem to have triggered a kind of feared bomb or cliff effect. And also, in fact, there is an early paper by Gourinchas and co-authors that already anticipated that using a macro model. So what are the explanations why this loan guarantee program was, quote-unquote, largely successful? Well, maybe there are several ingredients in this success. One is that it was in response to a largely observable shock. There was a limited scope for moral hazard by borrowers because you could see who was more in trouble and who was less. And also because the program, partly because of that, could be relatively well designed with standard loan sizes based on the sales of firms. Most guarantees being less than 100% coverage, so that some skin in the game was left. And also, guaranteed loans were mostly granted by large, liquid, and well-capitalized banks. But also, importantly, there was probably, although it has not been documented so far, and actually this would be an interesting topic for future research, there was probably a beneficial interplay, and here we come to the topic that Farzad wanted me to address, beneficial interplay between the loan guarantee program and short-term work programs. Because effectively what these short-term work programs were doing, they were giving implicitly equity to firms, which complemented to some extent the ability of these firms to go more into debt because this debt was being guaranteed and so more generously handed over by banks. And also there were some partial bailouts, like some, for instance, airlines were partially bailed out. Short-term work programs had also an additional feature that, of course, they enabled labor hoarding. So effectively, they avoided the breakup of successful firm-worker matches, and this enabled actually many firms in the Eurozone, but also in the United States, to actually sprint back to previous pre-COVID activity levels once demand resumed and once COVID receded. Can we say that now that these type of things like loan guarantee programs, short-term work programs are kind of a panacea? Well, we can't. Actually, it depends on the particular type of a very asymmetric, very sudden type of shock that they were so successful. In the future, probably firms are going to face other types of shocks, such those linked to technological innovation, environmental transition, geopolitical shocks, and to face these shocks, they will need to invest in restructuring, and they probably already need to invest in restructuring, provide managerial effort. So moral hazard problems are probably going to be more of an issue in the future than they were during COVID. Let me conclude with one note, since this panel is about macroprudential policies, with macroprudential policies. Can we say that, in a way, the COVID episode has taught us that the macroprudential policy is kind of irrelevant or not so useful? I don't think so. For reasons that Cornelia elucidated very well, these policies are super important, and they are going to be particularly important right now because we have several potential triggers of financial instability. We can see every day on the web and newspapers that there is huge uncertainty in markets due to the transition from restrictive to expansionary monetary policy. There is also a huge uncertainty about whether we are likely to have or not to have a soft landing. And markets are every day second-guessing the timing and magnitude of the moves of central banks. And that's a source of instability. Another source of instability, potential instability, is, as we know, potential bubbles linked to the valuation of artificial intelligence stocks. In fact, we already have seen market crashes occurring. There are the risks from financial innovation that Cornelia referred to, especially in the non-bank sector, so essentially in the private equity and credit fund markets, which are becoming increasingly important, at the same time increasingly dependent in a hidden way often on bank financing. And finally, but last but not least at all, geopolitical risks. Every day we see the danger of not only tariff but actual wars escalating. Conclusion. COVID-19 has shown to us that fiscal policies can be a precious addition to our stabilization toolkit, but it has far from eliminated the usefulness or potential usefulness of macroprudential policies.
Wonderful, thank you very much. All right, so to kick off the discussion first among the panelists, I think we heard a lot about, the success of previous stabilization policies, both financial and non-financial, and the interaction thereof. And we, at least on the sideline, heard about the relevance for stability of the non-bank financial intermediation sector. Now, given that current macroprudential tools and policies do not account for non-bank financial intermediaries and non-financial stabilization policies, and given the discussion we just had, shouldn't this call for recalibrating macroprudential policies? Just throwing this out there.
Should I have a go? Okay, no. So, I think we should always recalibrate or improve our thinking. No, as I said, so I think here in the euro area, we are right now there that we try to, we try to really build up the macroprudential buffers now for the banking system and also come to some coherence, so to some common understanding how they should be built up, what are the analysis behind it, and to harmonize them also in some way, ideally. And this is already very tough. So I liked your slide, Florian, with the different macroprudential whatever measure. that's, so add another dimension on the country level, and then, so at least in some aspects, no, there are really, really differences there, and it's very, very hard also for outsiders, also for insiders, but especially for outsiders to understand this whole system and think of, I don't know, US investors who want to come in and invest in the European banking sector. They don't understand anything. It's very, very tough. So I think that's something we should work on. And then, as I mentioned, the non-bank sector, there are also really measures one should do. So I mean, there are groups going on under the Basel Committee and the Financial Stability Board that look at the liquidity mismatch, for instance, or like if an open-ended fund receives too many redemption requests, how you can maybe stagger this over time. So these are measures that are being discussed, or also how to limit leverage in some way, either at the entity level, but not so much like to tell a hedge fund that you can only take up so and so much leverage, because they will probably find ways around it, but also at the what they call the activity level. So should we increase margins and haircuts for repo trades, because a lot of the financing takes place via repo or on the derivative side. So I think there are so many things we are still looking at, so it's really evolving. And I think also the perception that it's a useful tool, I think, is increasing.
Whenever you talk about recalibrating, one essential thing is measuring. I mean, to recalibrate, you must measure. And I remember I've been the chair of the Advisory Scientific Committee of the SRB for some time. And I remember one project that we had, and I don't know whether it has been carried out afterwards, I hope so, was how to measure the so-called macroprudential stance. Just as you measure the monetary policy stance, but measuring the monetary policy stance is a matter of measuring a couple of indicators, maybe one. But as you saw from Florian's slide, there you have, how many? Probably 15 different little bars to look at. The interplay between all of those, and of course, therefore, measuring whether the macroprudential stance of a given country is expansionary, neutral, or contractionary is already very difficult. Now, when you add the other dimension, which is the cross-country dimension, where each country has different agencies in charge, maybe of different policy tools, it becomes very complicated. So the tendency, the conclusion that you could draw is, this is hopeless. Let's drastically simplify. But we should be careful about not throwing out the baby with the bathwater there, because one of the merits of macroprudential policy is precisely that you can actually go and address specific problems which are generated by, factors of instability that are borne by, say, hedge funds, or by this or that. So but you pay a price, because differently from monetary policy, it goes in all the cracks. There, you have to go personally into all the cracks with each of these tools, but then you don't know exactly maybe what you are doing. So I don't have a kind of quick answer, but I guess that one very important task at the level of an institution like the ECB or central banks in general would be to be able to measure the stance of monetary policy and take into account, altogether, given the way you're pulling all these levers, so what is the stance of that particular country or institution? Okay, let me stop here.
Well, if I may add one thing, when we're talking about recalibrating macroprudential policies, well, at least ours, in response to the evaluation of the recent series of other stabilization policies that have been implemented, in particular in response to the COVID-19 crisis, we face difficulty that, as Cornelia put it, we implemented many policies at the same time, and the simultaneity simply makes it very difficult to disentangle the underlying mechanisms, right? So it might well be that we see an aggregate outcome that this has interacted with macroprudential policies that were in place and everything went more or less smoothly, but we wouldn't know why. And there's no way we can turn back time and introduce staggered timing of these policies and randomize some more. We did not, right? We were just all reacting in shock to the mother of uncertainty shocks, that was COVID.
Absolutely.
Well, there was one point I found very interesting was that we had two proponents of capital regulation in the beginning. I was surprised to hear that. Florian, you hinted, I mean, one interpretation of your argument was that you hinted at the potential complementarities between liquidity and capital regulation. Now, if we think about why we need capital regulation in the first place, one potential motivation for that was the moral hazard involved in government guarantees and lender of last resort principles, right? And that this may incentivize banks to take on risks excessively, and that's why we need capital regulation. Now, if liquidity regulation actually is good at curbing this kind of risk-taking, doesn't that undermine the need for capital regulation? And another player here may be the non-banks, because there are papers now showing that non-banks continue to provide credit when banks do not, for example, in response to contractionary monetary policy. And that would actually feed back to the same mechanism I have in mind right now. But what do you think?
You know, without going to the details of the paper, I think generally I never really liked the argument that the equity kind of curbs the risk-taking because there's something at stake. I don't think that has worked too well, but could also be that the levels were too little. I think in general one should view capital regulation as a tax on banking. And that's not a bad thing. I mean, I think Marco has a view on that. I think we have a lot of banks in Europe, and fewer is not necessarily worse. And there are externalities. I mean, the banking has always a public good aspect to it because they provide money, right? Payment services. So it's a public good to part extent, but it's also private enterprise. As the public good, it imposes externalities on the economy. And if it goes too much, then the capital regulation is one way to tax this in a sort of, you know, very sort of sufficient statistic way. I mean, you know, when you do certain public interventions, you always don't want to know the exact wealth of someone. You look at some aggregate measure, and that was my point, that equity is a good measure. And then when it comes to the non-banks, my prior would be not to regulate them. There's a little caveat there, because these are private enterprises. There's no public, they don't provide money. They're not able to be run upon. They're private enterprises. If they take unnecessary risks and they fail, you know, that's okay. I mean, that's what business is all about. So the one caveat is that when they have significant connections to the banking system, but then you could view that, right? I mean, the banks need to be transparent about their explicit or implicit guarantees to someone outside the regulatory realm, and then top up the equity requirement, and that's it. But otherwise, leave the non-banks alone. I mean, that's where a lot of innovation happens.
So may I come back on this point? You just said that capital regulation requirements are like a tax on banking. I think it's much better than a tax on banking, no? I mean, some countries in the euro area, so Italy, for instance, and Spain, and I think Lithuania, they discuss now taxing the banks in the last few years because they were making now profits, no, with their rapidly rising interest rates. So some countries implemented that, some discussed it, and in Italy, interestingly, they had a system where they introduced the tax but they gave the option that instead the banks could hold more capital buffers. We thought it was great because, of course, all the banks opted for the capital buffers. No, because it keeps the money, but it keeps the money in the banking sector and not giving it to the government, who arguably, I don't know what they do with them. Okay, but it's a different issue, but it makes banks safer, and that's, I think, what's the important part. So I would think it's superior to a tax on banking. And then on your point on liquidity regulation, so I mean, liquidity requirements, they are tough to understand, I think, and because I mean, we have seen many examples where the banks that later got in trouble, they had quite good liquidity requirements. Credit Suisse is a case in point. I mean, they fulfilled all the requirements until the very end, but then we know the run comes, the money is gone in nowadays in half a day, yeah? But still, I think there's a value in the liquidity requirements. But first of all, because the system holds the liquidity, and then secondly, because it provides confidence. So when Credit Suisse went down, I mean, there were all these rumors and market movements targeting the next weakest banks, yeah? And so for Germany, it was Deutsche Bank. So there was there were movements in their CDS pricing and AT1 pricing, and you know, we were all a bit on high alert that now a European bank, Euro area bank could also be hit. But they had such good capital buffers and liquidity buffers at that point in time, and I think it really calms the market. So at least, I mean, because I think a lot of runs that can happen, they are of a systemic nature, also because no one really knows in a certain moment in time what the situation is like. So it's a market sentiment issue. So everyone thinks, oh, I better get all the money back to me before, and then I start to understand whether that's actually a problem. But with that behavior, you create a problem. So I think, yeah, it has a value.
Yeah, I totally agree with what has been said before so far. And I wish Professor Helvig was in this room, because it would be music to his ears to hear this beana in favor of capital, bank capital. As, you know, the important qualification is the final one that Florian made, that, you know, it could be that in some kind of hidden way or very complicated way, eventually banks find a way to fund non-banks and therefore put their capital at risk in ways that we do not understand, that not even the regulator understands. And they have a strong incentive to do so because they want to raise their profitability, because, of course, this tax actually lowers their profitability. In order to you know, raise it back to what they consider an acceptable level, they start taking risks by funding non-banks in ways that we do not fully understand. And there is a constant chase between the regulator and the banks. And there is a very nice paper by Viral Acharya, recent ones, that shows that even though on paper it looks as if the non-banks are becoming much more important for the financial system as a whole, actually they are becoming increasingly important through links with the non-banks, and therefore in a way which is potentially destabilizing for the financial system. And this is very dangerous. Also because the imagination of those who design non-banks and the way they fund themselves from banks is almost unbounded.
I guess before opening the floor and take audience questions, I think one important differentiation we should make, though, is between regulated, non-regulated non-banks, right? Because, I mean, if you look at regulated non-bank financial intermediaries, we're talking about life insurance companies, which, to the best of my knowledge, in the Euro area are some of the most important providers of long-term funding of banks. And we are giving banks all the incentives in the world to reduce the maturity mismatch to some extent by extending more long-term, issuing more long-term debt. And who's funding that? It's insurance companies. So we have, and that would also, that is, to me at least, is a good, neat example for why we need macroprudential policy to incorporate that, because we're looking at two differently regulated financial institutions that are now in a financial contracting nexus, right? Good. So, yeah, Falco, why don't you go first? He has so much gravitas, he doesn't need a microphone.
If I just listen to Florian, I mean, when I thought about what is the next financial crisis that you can see coming, it is probably a fiscal or sovereign debt crisis. And that was led me also to the question, to what extent do we need also a macroprudential policy tool that takes sovereign risks somehow into account? Right, in particular, given that we see, I mean, we probably all see it a little bit coming, right? But probably not only because we want to somehow, again, mitigate the doom loop. But also, I mean, following the other presentations, right, the fiscal policy is also the last line of defense in banking crisis. And if we don't have any leeway in fiscal policy anymore to stabilize the banking system, then we also need to increase the resilience of the banking system itself by increasing macroprudential policy tools, countercyclical capital buffers, or what have you. But I don't see that this is so far taken into account, and maybe we need to start thinking about that.
I would totally agree. I mean, there's always the myth why sovereign debt has zero risk weight, right? I mean, that would be a good place to start. The whole point about equity is bringing in private money to bear the risks that at some point maybe the public sector cannot do anymore. And let me just use the opportunity. I mean, the tax amended in the economic incentive, right, that you don't do a certain activity. It wasn't the sort of public economics kind of you want to raise money, right? So, which is a different issue because it just to curb the activity. In Credit Suisse, actually, I would have a different view, right? I mean, we only look at the last moment, but they had outflows of more than 100 billion euros the year before and 70 billion the year before that, and they were able to withstand that precisely because they had a lot of liquid assets. It's just that they hadn't learned the lessons. I mean, nobody kind of said, okay, there's a lot of withdrawals, something going wrong, just keep going, right? And you know, again, this is the train wreck waiting to happen, which was very obvious, but again, you know, nobody pulled the plug.
Yeah, but may I come in on this? So I think the banking supervisors in Switzerland, they knew very well the state of the bank, no? I mean, we know it was being under restructuring also. That didn't happen fast enough. But I think they were quite well prepared already in the fall of the year before that. But how can you close a bank that fulfills all the requirements? So there is some leeway that supervisors have, no? I mean, just legally. I mean, maybe you need to change the law, but I mean, under the prevailing conditions, there's then not so much that they can do. They can prepare for day X, which they did, but yeah, it's not easy to, because you will be sued from all sides. I mean, they are sued from all sides now anyway, but I think now they are in a better position. So it's hard. I mean, remember when Elke König, the chair of the SRB, said in an interview something about Banco Popular, that they were looking into it. The next day, the bank was gone. So you don't want to be in court for that.
Confidence. Yeah, it's a very, very
Any other questions? As far as I know, there's no food outside, is there?
Exactly. I know. I think about that often.
Okay.
Yeah.
No, there is none, so you might as well spend more time here. Or we conclude by thanking the panelists for what I thought was a lucid discussion, talking about the current and the optimal scope of macroprudential policies and the dire need to keep thinking about them and probably continuously monitor them as the world is evolving, because for better or worse, COVID was probably not the last shock to our beliefs and testing the boundaries of uncertainty and how much of it we can handle. So stay tuned, and I wish everybody a wonderful conference.